One of the primary drawcards for trading options is the asymmetrical risk profile for a long call or put, the ability to gain directional exposure with leverage but still have limited risk. However, long options carry substantial time decay that works against the options buyer. So in today's video, we will explore leveling up your options from single-leg to multi-leg debit spreads and their potential benefits. A debit spread is an option strategy that is suitable when you expect the underlying to make a substantial move higher, for example, a bull call spread, or lower, for example, a bear put spread. It consists of simultaneously buying and selling a call or put with the same expiration at different strike prices. For example, if a stock is currently trading at $170, buying a $170 call option and then selling a $185 call option creates a bull call spread. The long call is the strategy driver in this example, providing the upside exposure with limited risk, while the short option will collect premium and reduce the overall risk and capital requirements of the trade. The short option also provides a partial offset to the time decay of the long option. And the primary trade-off with a bull call spread, compared to a long call, is that the gains are capped at the upper strike in exchange for the lower risk. Next, let's dive into the mechanics of constructing a bull call spread and a bear put spread using XYZ as our example, with a current price of $170. To create a bull call spread, which is optimal in a rising bullish market, you might consider buying a call option with a strike price at the current price of $170 for a $5 premium, and simultaneously selling a call option with a higher strike price at $185 for a $1 premium, with the same expiration date. This results in a net debit of $4. That would be the maximum risk. The premium received from selling the $185 call would offset a portion of the cost of buying the $170 call, creating a net debit. The break-even for this strategy would be the strike price of the long call plus the net premium paid. You would realize the maximum profit potential if XYZ were to stay above the short strike of $185. The maximum loss would occur if XYZ were to decline below the long strike of $170. In this example, the maximum profit potential is the distance between the two strikes of $185 and $170 minus the net premium paid for a total of $11. On the flip side, for a bear put spread, which is suitable for a declining bearish outlook on XYZ, the strategy involves buying a put option with a strike price at the current stock price of $170 for a $5 premium, and selling a put option with a lower strike price at $155 for a $1 premium, with the same expiration. The net premium between the two legs is a debit of $4. That becomes your maximum risk. If XYZ declines below the lower strike price of $155, the strategy will realize the maximum profit potential of the distance between the two strikes of $170 and $155 minus the net premium paid for a total of $11. And if XYZ were to stay above the higher strike price of $170, you would realize the maximum loss potential of $4. In both examples, only if XYZ were to move beyond the short strike of the strategy would you realize the full profit potential at expiration. And if the stock did not move, you would realize the full loss potential on the strategy. Even if the stock were to move slightly in your favor, but did not exceed the break-even price, you would not be profitable. Now let's discuss how time decay impacts a debit spread trade. Since the strategy driver of a debit spread is a long call or put, it carries negative time decay. As a debit spread approaches expiration, the time decay accelerates and erodes the value of the option. Generally, this is why some investors may choose to close out or roll their debit spreads before expiration to avoid the acceleration in time decay. In summary, a debit spread can provide a blend of two key features of options: leverage for a directional view with limited risk, and the ability to capitalize on a strong expected move through speculative trading. It allows you to take a directional view with a higher probability of profit and lower risk than a single-leg long call or put. These features make debit spreads a practical strategy when you expect a sizable move from the underlying. Visit bmo.com/online investing to get started.